Okay, well, good morning, everyone. I'm Cary Hegreberg with the Montana Bankers Association, and thank you for joining us on this webinar. We hope it's going to be relevant and valuable as you pursue forgiveness with your lender. We have a lot of lenders on the call right now, as well as small business owners. And we'd like to thank the Montana Chamber of Commerce and Anderson ZerMuehlen Accounting for working with us as we offered this webinar. Todd O'Hare with the Chamber will be joining us at the conclusion of the webinar to help facilitate some questions and answers, and like to again thank the Chamber. Our two organizations have found some great synergies throughout this crisis. It's the goal of bankers and lenders, obviously, to help their small business customers, which are represented by the Chamber. So we've tried to partner throughout this crisis in offering relevant information to both lenders and small businesses. We were approached by our mutual member, Anderson ZerMuehlen, about a week ago and asked if we'd be interested in co-hosting this webinar. And of course, we said we would, because both bankers and small business owners are very anxious to work through this process as efficiently and expeditiously as possible. And so again, we thank you for joining us this morning. I think everybody is on mute. Please make sure that your audio is muted so that our presenters can have a clear channel throughout. Please feel free to use the chat feature as we move forward and be able to ask questions. We'll be moderating those chat questions, and at the conclusion of the presentations, we will be opening up the webinar for questions and answers, and we know there will be some. So again, we'd like to thank AZ, Anderson ZerMuehlen, for extending their expertise this morning. And I'll start by introducing Jim Woy, a CPA and shareholder with AZ. Jim has practiced in public accounting for over 40 years, providing tax and advisory and attest services to small and large businesses and their owners, local governments, and nonprofits. He's been named one of the AICPA Outstanding Discussion Leaders and is a leader in the accounting industry through his teaching and technical review work. Jim teaches technical accounting content on a national level as well as within Anderson ZerMuehlen. He's instructed courses at the University of Montana and Montana Tech, and coincidentally, he serves on a community bank board of directors right here in Montana, making him a perfect fit for this seminar. Jim will be followed by Angela Murdo, also a CPA and shareholder with AZ. Angie graduated from the University of Montana with a bachelor's in science, bachelor's of science in business administration and a master's of accountancy. She's been working for AZ for about 18 years, and she is the firm's financial institution team leader. She's also a member of the firm's newly established PPP team. So welcome to both Jim and Angie. And another reminder to make sure everyone's on mute. And Jim, I'll kick it over to you to get us started.
All right, thank you and welcome everyone. Very excited to have an opportunity to present some pretty important information to everyone if you've been touched by the PPP program. I would like you to just maintain your focus over the next 90 minutes. We're very happy to answer questions and comments in the chat room. As you make those questions, we will be tracking them, and we're leaving 25 to 30 minutes at the end of the presentation for Q&A, which is a very key part of something that is obviously a moving target as we speak regarding how you apply for debt discharge on the PPP program loan that you've gone out and obtained. Okay, so some words of caution. Keep in mind that we are expecting updated guidance from the SBA and the Treasury that could easily change what we discussed today. Continue to check www.treasury.gov for posts that will bring more clarity to the rules that are out there as we speak. Many of you may have known that over the Memorial Day weekend, there's been more guidance issued, not just for borrowers, but also for lenders. And we're now on our third interim final rules regarding the PPP program. This is huge, and it's something we really want to make sure that we all understand to maximize the benefit that the government is providing small businesses. We'd like to first start off and just talk a little bit about, should I have applied for this PPP stimulus program? I have clients that have asked me this question. I believe certain recipients have maybe sometimes asked themselves, wow, this might appear too good to be true. Was it really meant for my business? Let's see if we can help mitigate some of the confusion as to why there is maybe some questions being asked by certain organizations that have applied for and received the PPP loan. Definitely there is confusion. On April 23rd, a rule was issued under the PPP program that loan forgiveness is intended really for those small businesses that have been adversely impacted by COVID-19 and who can certify in good faith that the current economic uncertainty makes the loan request necessary to support your going operations, as a going, not as a going concern, but as an ongoing entity. And you take into account your current business activity and your ability to access other sources of liquidity in a manner that would not be detrimental to your operations. This particular information that was issued on April 23rd, this rule, is specifically addressed in a question and answer document issued by the SBA, and it's question 31. Now, keep in mind that when many entities applied for and received the PPP program proceeds, they were operating under the April 6th interim final rules that said only current economic uncertainty, if it exists, which clearly there is continuing to be economic uncertainty, makes the loan necessary to support that small business's ongoing operations. Note that that is a little bit less strict than the April 23rd rule. So with that confusion, okay, business entities, specifically publicly held companies that originally applied for and received funds had until May 18th to return those funds. Many did, based on concerns of an audit, potential penalties, and no doubt negative press. And I put in parentheses Los Angeles Lakers because I'm sure many of us on this call today can relate to the fact that that brought some significant press when word got out that the Los Angeles Lakers applied for and received some of these funds. So over $1 billion did go to 300 publicly held companies. So that did create some concerns by Treasury and the SBA. And obviously we all know that, there was that infamous decision that had to be made, should companies return their funds. And due to the changing goalposts here, due to the confusion that was just brought to your attention, okay, many believed that when they applied for and received their funds, they did so under the rules that were in effect as of April 6th, and they feel very comfortable keeping that money and going through whatever potential oversight or audit may happen down the road. I agree with that. I totally agree that you should be applying the best available information at the time that you applied for these funds. And I know from our perspective that where we helped many small businesses, that was our take as well. and we followed what rules were in place at that time. So just as a quick summary, small businesses are defined as businesses that have 500 or fewer employees or meet the SBA employee-based standards for the industry to which it operates. Okay, so this money was intended for small businesses, right? In late March, the PPP allowed the alternative size standard to kick in, which said if you have more than 500 employees and you had a net worth of less than 15 million at March 27th of 2020, and your average net income over the past 2 years was less than 5 million, you could also participate. And the important point to be made there is this opened up the opportunity for a large number of not-for-profit organizations who has a mission, an exempt purpose to provide services to those in need. And in many cases, those nonprofits have a large number of employees, but this alternative size standard helped them and made them eligible as well, which was a very good thing. So the major objective of Congress, very quickly, is to keep employees employed and using the PPP program to do just that, right? And keep them away from the unemployment lines. It's about job protection. And finally, the world is facing a pandemic that no one, absolutely no one, can predict what impact this will have on your business in the coming weeks, months, and even years. It is very difficult to really try to quantify the impact of this pandemic on your business today. So you should not feel like, based on wherever you may be from a financial metric standpoint today, that should determine whether you were entitled or not entitled to this PPP loan, because you just do not know. Clearly, we're in an environment that could get significantly more negative as time passes. So the key point is if you met the requirements when you submitted the application, your PPP loan should be eligible and you should move forward very comfortable with that. Okay, a little bit about some practical guidance on understanding and preparing the application. So important. As I walk you through a few of these slides, I want everyone to kind of just sit back and kind of listen to what is being said, because sometimes the slides could appear a bit overwhelming when I throw a table out there, but it's really not that complicated. But the concept is more about having your ducks in order, having good documentation, and we're going to try to help you visualize that with some slide shots as we move forward. But I can tell you, this particular program, these are the things that you need to know, right? We've all received the first draft of the program loan forgiveness application. It may appear a bit overwhelming, but clearly we have it, and even after the third interim rule has been issued, many of the questions, many of the schedules and tables remain unchanged. So we're through 3 interim final rules, and this application that is out there in its first draft continues to be a good document to help you calculate your debt discharge that will occur as you work through this application. As I mentioned earlier, over the Memorial Day weekend, the Treasury and the SBA issued interim final rules on loan review procedures, as well as borrower and lender responsibilities. So again, they were busy over the weekend, but for lenders and borrowers out there, we now have some recent guidance that will help us all better understand this process. So just quickly, what are the borrower responsibilities? Provide an accurate calculation of loan forgiveness, okay, which is the responsibility of the borrower. And the borrower will certify as to its accuracy, right? certify as to its accuracy. You can't delegate that to a third party. You can't delegate that to your lender. The borrower certifies to the accuracy of the information, including the calculations within the application. The borrower shall not receive forgiveness without submitting a complete application to the lender, and in addition must supply to the lender all documentation to support the payroll and non-payroll costs included in that application. Wow. And that's where the key point is going to come, is lenders should be emphasizing to their borrowers right now the importance of getting accurate information submitted. The lender will be challenged to do a deep dive review into each application. When I say challenged, I mean they're not going to have really the resources to go in and do a deep dive for each and every application. And it will be vital, absolutely vital, that the application is submitted to the lender that is accurate and complete the first time. Lenders can expect many of these applications to come in around the same time. We know that once your 8-week coverage period is up, you are able to begin completing the application with the supporting documentation and submit it. And we know that when we get into the middle part of June, there's going to be a lot of 8-week periods that have come and gone. So we want to make sure that lenders are reminding their borrowers to be sure that they're putting appropriate resources into this particular application. Now, from the lender's responsibilities, okay, comes the following. Okay, they're required to issue a decision on loan forgiveness to the SBA no later than 60 days after the receipt of the forgiveness application by the borrower. So the lender has 60 days after receipt of a complete application to submit it to SBA. Lenders are expected to perform a good faith review. A good faith review is not a cursory review, but a good faith review can take into consideration who helped prepare and what kind of documentation was provided. If it was done under the oversight of a CPA firm, their accounting firm, or other people that are very knowledgeable in the PPP environment, bankers may not be as diligent. When I say diligent, I mean as real, getting into the real details as much as if they knew that it was being submitted by a borrower that really wasn't sure what he or she was doing, and it's pretty clear from the initial look that a lot of checkups are going to be necessary. So definitely recognize that this is the time to be sure that what advice you can give borrowers should really help the lenders, because it is going to be a very, very significant process to go through and get all these applications submitted. If the lender identifies errors, okay, or material lack of substantiation in the borrower's documents, the lender will need to work with the borrower to remedy that issue. This is where the time issue can become significant, and the resources of the lender, which are already going to probably be tight, are going to be consumed significantly due to this. Okay, let's just quickly talk about some of the SBA responsibilities. SBA, subject to any SBA review of the loan or loan application, okay, will remit the forgiveness amount to the lender plus accrued interest from the date that the loan was funded by the lender, okay, no later than 90 days after the lender issues its decision to SBA. So what happens is SBA, within 90 days after getting the complete application and the lender's recommendation on debt forgiveness, they have 90 days to either agree with the lender, modify the lender's decision, or reject the lender's decision. and they may reject it because they believe there may be potential fraudulent or inaccurate applications that are being submitted and fell through the cracks, and obviously now SBA will deem those ineligible. And then finally, SBA will not reimburse lenders their loan fee on loans that are deemed ineligible. So clearly, you want all the work done up front by the borrower, good, complete information, and hopefully the whole process will work very smoothly with that happening. There is a 1-year clawback provision on bank fees that were paid to the lender, and if the loan was ruled subsequently to be ineligible, the lender must repay the fee back to the SBA. So a lot of new information out there, but definitely something that is worth understanding the process so that we can get the best and accurate information right up front when it's submitted to the lender. So read the form, read the 11-page application. It sounds overwhelming, but read the form, and it is a pretty good read. It's pretty straightforward, and it helps lay out exactly what amount of your PPP loan will be eligible for debt discharge. Solicit the help of your CPA or accountant who understands your business, who has studied the PPP program and understands, yeah, there's some shades of gray. There may not be clear and concise guidance, but at the end of the day, they will work for you. Remember that spending a little bit of energy and time and money to get your maximum discharge is definitely the smart thing to do. Trying to cut corners, trying to do it yourself, inevitably creates stress, and it ultimately can affect how much you're going to get back. Again, if you're not comfortable with the PPP program, work with people that are. I must say that I've had situations where many borrowers don't even realize it today, applied for their PPP loan with incorrect information and ended up receiving less than they were entitled. I can't emphasize enough that this is your one golden opportunity to get the maximum reimbursement under this program by doing it the right way and definitely the smart way. Okay, let's move on. Some key definitions. When you're completing the form, you need to understand that you're going to get reimbursement. You're going to get debt discharge for gross compensation paid to your employees. There's a lot of questions out there. Do we have to reduce a person's gross compensation by elective deferrals into 401k plans, elective deferrals into health savings accounts? You know, lots of questions. The simple answer is no. You get to include gross compensation paid to your employees over the 8-week covered period, right? Now, you also have to realize that your highly compensated individuals will be capped out at $100,000. So if an individual makes over $100,000, the maximum reimbursement you will be able to apply for under the program will be 8/52 of 100,000, which comes to $15,385. That's the maximum amount for each employee that is paid over $100,000 a year for reimbursement or for debt discharge purposes. Okay, so just make sure you got a good understanding of your gross compensation. Average FTE. This is an important calculation in this application because the whole idea is that if employers reduced the number of employees during the covered period because of they weren't open as many hours or they had to shut down completely and they couldn't pay their employees, this does affect, it's a big deduct. It's a big haircut from how much you can apply for reimbursement or you can apply for debt discharge. So you have to be very, very methodical in calculating your average FTEs. And I'm going to illustrate how you do that in just a moment. But keep in mind that if you have employees that work 40 or more hours a week, it don't matter if they work 50, it don't matter if they work 60, it don't matter if they work 43. You max out at 40 and you get a 1.0. You get a 1 for every employee that works 40 or more hours, right? Okay. If you have a part-time employee that works less than 40 hours, then you have to convert that part-time employee into an FTE equivalent. And you do that by dividing the number of part-time employee hours by 40 and then round up to the nearest tenth to get the FTE equivalent. And I'll illustrate that for you. But lo and behold of the simplified FTE method, let me emphasize that many small businesses don't really have timesheets. They don't have time clocks. They can't really be really accurate on whether some employees work over 40 or under 40, but they consider certain number of employees full-time and they consider maybe certain number of employees part-time. You can do what we call a simplified method, assign a 1.0 for each employee that works full-time, basically gets paid for 40 hours more or more a week. Or for every part-time employee, you can go ahead and assign a 0.5, and you'll get a 0.5 for each and every part-time employee. So it's a simplified method, but you'd have to see which one works. I can't emphasize enough that during certain periods in 2020, if you reduced an employee's hourly rate, say from $15 an hour to $10, or their annual salary from $80,000 down to $70,000. If you did any reductions to an employee's salary or hourly rate during certain key dates and periods in 2020, you may be also subject to a haircut on how much you can get back under this debt discharge, okay? But I always remember that if you did a haircut, if you had to cut a person's salary a little bit or cut their hourly rate, if it wasn't more than a 25% reduction, you don't have to worry about any of this. It's only for those reductions that exceed 25% of what they were originally making with this salary and hour reduction kick in. Okay, more about that in just a few minutes. Let's talk about sole proprietors, general partners, and LLC members. Now, a sole proprietor generally owns a small business, is not incorporated, files a tax return as part of their personal 1040, and how they get into this situation is as follows. You look to see how much cash compensation or the amount of cash compensation eligible for forgiveness is capped at 8/52 of his or her 2019 Schedule C business net income. So you're capped at 8/52, 8 weeks out of 52 weeks of your 2019 Schedule C business net income. If you're a general partner, the total amount is capped at 8/52 of your total 2019 income subject to self-employment tax, which will show up on a K-1, right? And you would then further reduce that by your your Internal Revenue Code Section 179 expense, if you took that, as well as you have to do a little further reduction for some self-employment tax you get to deduct as a self-employed. So you would multiply that number by 92%. Again, it's a straightforward calculation, but that's how you would end up determining how much is eligible for forgiveness. The LLC member electing partnership tax reporting, same thing. 8/52 of the 2019 income subject to self-employment tax passed through to the member on his or her K-1, again, reduced by those items. So that's kind of how we deal with sole proprietors, general partners, and LLC members. And this is a big deal here. Look at the key point. You can't use health insurance premiums or retirement contributions paid for this type of group, for your sole proprietors, general partners, and LLC members. If you're an owner employee of an S corporation or a C corporation, you get to include those additional payroll related costs, but not if you're a sole proprietor or a general partner. Okay, let's quickly remind people what are some of the key amounts and dates you have to document. Document how much you received when you applied for the PPP program. Was it 45,000? Was it 1.2 million? Was it 6.6 million? Whatever it is, document that. Date that the loan was dispersed and put into your bank account. The date that it went into your bank account is a key date and will drive the covered period that you're going to be determining now for your 8-week reimbursement of payroll and non-payroll costs. So look at the date of the first pay period that followed your PPP disbursement, okay? And we'll get into that in just a moment, but that's a key date. And then once you make your decisions, which I'm going to walk you through in just a moment, you will identify the beginning date of your 8-week covered period, and you will determine the ending date of your 8-week covered period, okay? These dates are critical for you to get to the best 8-week period that will provide maximum reimbursement for you under this debt discharge program. So the first thing you want to do is you get to choose your periods here. So let me tell you what I mean by that. You have an option to use 8 weeks starting on the date that your lender deposited your loan funds into your bank account, okay? That's using the actual 8-week covered period. Here's the example. You received your PPP loan proceeds on Monday, April 20th. The first day of the covered period is April 20th, and the last day is Sunday, June 14th. You have to count the date the money goes into your account, and then you go 55 days past that to get to the end of your 8-week period. We call that the actual 8-week covered period. You choose whether you want to use that period, or if you want to look at a second option that says you can consider using the alternative covered period if you don't want to use the actual 8-week covered period. What do I mean by alternative covered period? Only borrowers that are on a biweekly or more frequent payroll schedule may elect to calculate payroll costs using this alternative covered period. And this is where you take your actual date the money hits your account, right? And what you do is you then look for the first paid period after that loan disbursement date. So let's say you get the loan on April 20th, the money hits your account, and the first day of your next pay period following that disbursement date is Sunday, April 26th. Well, that makes sense because most weekly and bi-weekly pay periods start on a Sunday. They end on a Saturday. So you go out to April 26th. That becomes your first day of your 8-week covered period. So when you do the calculation here, The first day of your covered period is April 26th, which is Sunday. The first pay period date after you had received the loan, and the last day becomes Saturday, June 20th. I personally like the alternative covered period if I was on a weekly or biweekly pay period status, because it will for sure cover 8 full weeks of payroll. No question, and it's pretty straightforward. Practice makes perfect, folks. Take your actual payroll periods that you've already incurred for the first few weeks that you are in your covered period. Do a calculation this week or early next week, get it current, and then estimate any unexpired payroll periods remaining for your 8-week period. And so you can get a pretty good understanding of how much payroll related costs you're going to be eligible to seek forgiveness. Okay? Don't just wait until your 8-week period is over and start throwing around some numbers. This application now is perfect for you to get a pretty good understanding of how much you're going to be eligible for reimbursement. Now, you're looking at a table that for accountants, they might say, no big deal. But for most rational people, they're saying, oh my God, what are you putting in front of me right now? This is quite simple, simply a simple table, but I need to explain it to you so you can begin to understand the concept of FTEs. So you're looking at 2 weeks in an 8-week period, okay? A summary of 2 weeks. The week of April 20th, in my hypothetical example here, has a company that has 15 full-time employees, okay? And they have 4 part-time employees during this week that started April 20th, the first week of this hypothetical company's 8-week period. The sum of all the hours worked by our part-time people added up to 100 hours. So you take 100 hours and divide by 40 to get your FTE equivalent for your part-time employees. So even though you have 4 human beings working part-time, the FTE equivalent is 2.5. So for that week of April 20th, you have 17.5 employees, FTEs, equivalent. Week of April 27th, the 4 part-time employees worked 110 hours. You do the math, 110 divided by 40, you get 2.8. And you can see now that you have 17.8 average FTEs in the week of April 27th. Now, these are summations of a whole week. So you have to have a supporting spreadsheet, which is you see on my screenshot. It's almost like a split screen. You're going to have a supporting spreadsheet that will list every employee on your payroll, okay? You will document their status. Are they salaried or they're hourly? What is their salary or their hourly wage on 2/15 of 2020? 2/15 of 2020 is a key date. That date you want to document the individual's hourly rate or salary, okay? Then you're going to go ahead and you're going to have a schedule that is going to calculate each of your employees' average hourly rate or salary between a period February 15th and April 26th. So you're going to have a supporting spreadsheet that will do a calculation to arrive at what each employee's average hourly rate was or average salary was, annual salary for that period. Now, why did they pick February 15th to April 26th? April 26th is 30 days past the enactment of the CARES Act. And so that's the date that they have in this particular calculation. And then you want to document for each employee, as I read left to right on that lower screen, that split screen you see, you want to document each employee's annual salary or hourly rate as of June 30. 2020, because there is a safe harbor. If you reinstate an individual's wage or salary or hourly rate by June 30, you will not be given a haircut, or there won't be a reduction based on what reductions you've done on salary and hourly wages. And then most important is you have to actually do the gross wage payroll calculations for each employee for each of the 8 weeks that is in your covered period. So, the devil is in the details, but all of that information on the lower table there is what rises up and provides the summary that you see up above for, say, the week of April 20th or the week of April 27th. I can't emphasize enough, ladies and gentlemen, that you must retain records for 6 years after the date of the loan forgiveness in case an audit will occur with your small business. Okay, let's move on. So you're looking at a schematic of the 8 weeks for my hypothetical company. Okay, now, because I can't really fit 8 weeks on my table, the first 3 represent weeks, and then May 11th to June 8th just is 5 weeks with the same numbers. I mean, in all reality, that's probably not ever happen, but for purposes of my illustration here, for the 8-week covered period for my hypothetical company, I've calculated my average FTE to be 17.1 hours. How did I get that? I took my April 20th, first of my 8 weeks payroll, and I had 15 full-time employees, and I had 2.5 FTE equivalents, 17.5. I did it for the April 27th. I did it for May 4th. And for the next 5 weeks, just for simplistic purposes, I came up with 16.8. So you add all 8 of those average FTE column amounts, and you would get 136.3. You divide that by 8, and that becomes your average FTE for your 8-week covered period. Okay, so just kind of think about how simple that is, but yet you have to have the payrolls to support and the number of employees individually identified to support those numbers. Okay, so let's look at how this all comes together on this application. The most important schedule on this application, in my opinion, is Schedule A. Schedule A calculates, okay, the total payroll costs for that 8-week period for that small business, including any reduction for the FTE reduction quotient that I'll talk about in just a second. But this Schedule A has really 4 main parts. The first part is for all your employees making less than $100,000 per year. Table 2 is for your employees making more than $100,000, and there is a section on Schedule A that where you're gonna report compensation of owners, okay, who would be owner employees that receive W-2s if you're an S corporation, a C corporation, or it'll be where you would disclose the self-employed or the general partner compensation that we talked about earlier. And then the part 4 of this form is the most important, which is where you have to reduce your payroll costs by some FTE reduction quotient. So break it down so you can kind of understand how this works. You're looking at Table 1 right now, kind of on the, if you were looking at the form, it would look something like this. So Table 1 would show each employee, okay, and then whether you have an identifying number, whatever it would be, list your identifying number, because you probably, every employee should have some kind of an identifying number, not their full social. Cash compensation paid for the full 12 or the full 8-week period. In this case, P-Pen earned $9,600 over 8 weeks. and he is a one FTE. He's a full-time employee, and he earned gross compensation of $9,600 over the 8-week period. And there's no reduction for any type of a salary or hourly rate reduction. CCAN generated gross salary of $4,800, right? And basically he's also full-time, and he had no reduction for hourly or salary reduction. So in this small business that I'm bringing forth in this hypothetical, $54,400 would be the, well, let's just say that's the total. I just listed 2 employees, but basically the total would come through there and be the summation on table 1. Then you go to table 2 and list those over 100,000 that are paid 100 or more thousand. And in this case, you cap it at 15,385. And in this case, you have 2 employees that were paid over 100,000 or expected to be paid over 100,000 and can only use the 15,385 cap. They're both full-time, and there's no reduction for salary or hourly rates. Okay, and then the third section would be owners. Okay, in this case, we have an owner who is also paid over 100,000 a year, and he or she would be capped at 15,385. So you have these 3 key tables to address all your employees paid over 8 weeks that are paid less than 100,000 on an annual basis, and those that are paid over, and then your owners. Okay, and again, that gets reflected on Schedule A. Now comes the calculation to arrive at the potential FTE quotient that could mean you have to reduce your payroll costs because you've reduced the number of employee FTE equivalents in your business. You get to choose the reference period in arriving at this potential reduction. And when I say that is, you have your actual payroll FTEs over your 8-week period. Those are actual based on your covered period. And then you compare that average FTE to what your FTEs were in one of the reference periods that you're going to pick. So option 1 says pick a reference period from February 15th of 2019 to June 30. So you go all the way back to 2019. And for that period,
What does it look like?
For that period, take all the employees that you paid in that period and arrive at their average FTE, right? If you don't like that time period, you can elect to take the time period January 1. Please, if there's someone on that has not muted their phone, please mute their phone. I'm getting a lot of background noise. Under option 2, you would select the reference period from January 1 of 2020 to February 29. Which one works for you depends on where your FTE stood during those reference periods. If your FTEs are higher in the January 1, 2020 period to February 29th period, you would most likely elect the 2019 period, February 15th to June 30, because your reference period will be a lower average FTE, and you then compare that to your covered period, your 8-week covered period FTE, and you would find that you're not most likely going to have an FTE reduction. Okay, I'll show you an example of that in just a moment. If you're a seasonal borrower, you get a third possible reference period. So if you're a seasonal employer, you can pick any 12 weeks from May 1 of 19 to September 15th to arrive at your average FTE that you will then compare to your 8-week FTE calculation. So let's do the math here and see how this works. On Schedule A, in the last section I said is probably one of the most important parts of this application for debt discharge. You first ask yourself, did we reduce the number of our employees at all during the period January 1 of 2020 right up through the end of our covered period? No, we didn't. Did we reduce the average paid hours in any fashion? No, we kept everybody employed. It wasn't easy, but we didn't have any reduction in employees or paid hours. Then you stop right there and you take no haircut for your FTE reduction quotient. However, if you did have fewer employees during this time period, or if you paid out less hours of wage, then you must go through this final calculation. And so you'll go back, calculate your average FTE during your covered period, which you'll recall I did for you a few minutes ago, and I arrived at 17.1 FTEs, right? So if you go back to the screenshot earlier I had up, I calculated for my 8-week covered period 17.1 FTEs. I compare that to my FTEs during my reference period, which I get to choose. And you'll recall you had 2 options. And if you were a seasonal employer, you had a 3rd option. And I compare my FTEs during my reference period to my FTEs during my 8-week covered period. And as you can see, I had a reduction in my actual 8-week period. So now I have to reduce my payroll costs by that quotient. 0.95 is what I get to take on all my total payroll costs because I had a reduction in FTE equivalents. But wait, again, there's an additional safe harbor. And if you go back to that one table that I said was a bit overwhelming, where I had the split screen, you were doing some documentation in your supporting schedules on these dates, and you did some calculations. And so if your total average FTEs from February 15th to April 26th, okay, is calculated, and you look at your FTEs in that one pay period inclusive of February 15th, they want to know on February 15th, basically, what was your average FTEs. You have those 2 numbers, and if number 2 is greater than number 1, then you check your total FTEs at June 30, which is the 3rd key date. And if you've reinstated your people by then no reduction. All right. Otherwise, you would have that FTE reduction. So you can see that there is plenty of opportunity to still get yourself in a position to reinstate your FTEs by June 30, reinstate wages, salaries, hopefully to avoid any reduction as you calculate your loan from that standpoint. Okay, so very quickly, if the employer made a good faith offer to rehire during the covered period and the employee rejected the offer, the employee can be counted in calculating your average FTE. So you don't have to take a reduction in your FTE average because a person said, I'm not coming back to work for you. I'm making more money on unemployment than I would be working, so I'm not going to accept your offer to come back during these key dates in 2020. If that were to be the case, you retain the documentation of the offer and of their rejection, and then you turn around and within 30 days notify your state unemployment office that you made an offer to this individual, it was rejected, and that will be adequate documentation to allow you to avoid having to reduce your FTEs for individuals that felt it was more important to not go back to work but rather collect unemployment and in some cases make more than what they might have been making working for the small business. So what do we know now, right? We know that you can choose your 8-week covered period, as we talked about earlier, the actual 8 weeks from when the loan is dispersed, or the alternative 8-week period, which takes you to the first pay period post-date loan is deposited into your account. You can select a reference period to compare your average FTEs over your 8-week covered period to your average FTEs in the reference period that you choose. You also can use the FTE simplified method, right? 1.0 if 40 hours, 0.5 if an employee works less than 40, more of a simplified approach. Some additional payroll costs you don't want to forget to pay. Health insurance for your employees are included in the amount of discharge. Self-insured group health premiums, premiums paid to insurance companies, all included in this 8-week period that if incurred and paid, you are eligible to apply against your loan. However, you can't exclude, you must exclude any pre-tax amounts of employees that you withheld. Again, it would really just represent the employer paid health insurance. Don't forget that retirement contributions for the 8 weeks are also included in how much you can seek debt forgiveness for. If you're matching 401k deferrals, the employer gets the match. If you make a pension contribution of 5%, 6%, whatever, on an annual basis, you will be able to take 8/52 of that 2020 pension contribution, but you have to fund it within this 8-week period. Because if you're funding a pension or a discretionary profit sharing now, May of 2020 for last year, say you're a calendar year small business, that contribution wasn't earned in your 8-week period. So you can't use last year's contribution even though you paid it in this 8-week period. You have to look forward and say, at the end of 2020, we expect to make a discretionary profit sharing of X, and you can take 8/52 of that and fund it in this 8-week period. Remember, you have to incur it and pay it within this 8-week period. And if at the end of the year you ask yourself, why did I ever agree to pay $100,000 or whatever, because my year has gone, to the dogs because of the pandemic, you've got to be thinking about that now. Do you want to commit and make that discretionary profit sharing contribution now and fund it, or do you want to not do anything because you don't know where you're going to be at the end of your 2020 year? Tough decisions, but one you have to think about as you complete this form. And you get to take state employer taxes like SUTA against, as part of your payroll costs. So those are primarily the payroll related costs. Okay, very quickly, let's talk about the non-employer costs that you can take on this application for forgiveness. Covered period mortgage interest. If you're a small business and you have a mortgage loan with your lender, and that mortgage loan was in place on or before February 15th, 2020, any interest paid during the 8-week period, if it was incurred during that 8-week period, you can't prepay a bunch of interest and expect to get that to be part of your debt discharge. It's for the actual interest earned or incurred for that 8-week period, if that mortgage was in place on February 15th, okay? And same with rent. If you have a rental agreement where you're leasing property, real property, buildings, warehouses, or if you're leasing personal property, a vehicle, piece of equipment, If those leases were in place on February 15th, if you had entered into these leases on that date or before, any rent you incurred during your 8-week covered period gets to be included in your debt discharge. So real or personal property. It isn't just the building, it can be also the personal property rents. Your utility payments. Clearly, you can see here electric, gas, water, cell phone, internet access, and they do drop the term transportation in here. Again, these are utility payments you incur during this 8-week period that you are eligible for reimbursement or debt discharge. And note that no more than 25% of your PPP loan proceeds can be discharged with non-payroll costs. So the real key is to maximize your payroll costs and then to top it off with taking your expenses that you have incurred and paid within this 8-week period. Now, one final point before we go to a question and answer session. The non-payroll costs must be paid within the covered period or incurred and paid on the next regular invoice billing date. For example, Northwestern Energy bills you in July for the month of June, and your covered period ends on June the 20th. Well, when you make that payment in July, you're going to be outside your covered period, but if you make it before the next Northwestern billing date, you're going to be able to include that on your application. So it's not necessarily incurred and paid in the covered period, it's incurred and paid within the next, billing cycle on those, with those vendors that will qualify for some debt discharge. I know that's a lot of information. I know this is being taped and you can go back, you can refresh some of the comments made and look at the screenshots if necessary, but we are really anxious to get to the Q&A side. So at this point, I'm going to turn it over back to our moderator and have Angie Murdo start working on some questions and answers. And thank you for your patience as we work through this.
Thank you very much, Jim. Could you hand me back control? And I know Todd O'Hare has some questions prepared as well.
Excuse me. I can hear you. Angie, can you hear us?
Yep. Yes, I can.
Okay. Yeah, I don't know quite how to hand you back control, but you're in charge. You can, my screen will just stay right there. I don't think Angie has a screen to share, nor do you, right? So you can just start talking and we can start getting right into the questions and answers.
I think right now, though, Jim, you're the only one who can see the Q&A that came in until you give control back.
So how do I do that? That's a big question. I do not know how to give the control back.
Can you go to the participants and say Montana Chamber of Commerce and make them the host?
I sure can. Let's see, do I?
So
I just did. I think that should work.
All right, I'm the host.
You should have.
Thank you.
great.
What's that?
Go for it, Todd.
We're good now. Thank you,
Yeah, we're
everyone.
good.
My name's Todd O'Hare. I'm the president and CEO of the Montana Chamber of Commerce. And we're pleased to be able to partner with Cary Hegreberg and the Montana Bankers Association. I think you saw through this presentation kind of the reason, a big driving reason why we're partners on these sort of activities is that there's a relationship that exists between the lenders and the borrowing community. And I think that this presentation, courtesy of the folks at AZ, experts in this field, kind of speak to the importance of working closely with your bankers and bankers working with the lenders, and that each one has an important role to go through this process. And I'll just give you a quick update. Cary Hegreberg and I both were on a phone call earlier this week with Senator Daines talking about the PPP program, recognizing that there's some concerns amongst the business community and the lenders about its implementation. And one of the things that we were arguing for was extending the 8-week period out. And we're hopeful that Congress will address that. Senator Daines was going to take that up and move forward with that. And so we're hopeful that we're going to see an adjustment to that 8-week period so that you're not having to spend those dollars within the 8-week period. And then the other big point that we spent some time talking with Senator Daines about was the 75-25 rule, hoping that we could get that so that there's a little more flexibility so that you're not just stuck with having to allocate that those dollars in that 75-25 rule. So those are a couple of things that we were talking with Senator Daines about. He's very receptive to, and so we're hopeful that we can see some adjustments to that. And so Jim and Angie, we got a number of good questions that came in while you were presenting. And one of the ones was one of the ones that we talked about before we started the webinar. And there's a question about how the forgiveness is going to be handled for tax purposes under today's rules. And can you explain that if your loan is forgiven, how is the taxes going to be treated on that when it's time to file taxes?
So it is a good question. And right now there is guidance out there, but as with everything else, we're not sure whether or not that will change. But as of now, it is not taxable. So you're not going to be taxable on those forgiven funds. However, the IRS at this point is saying that it's also not deductible for those expenses. We know that that's something that, like the other moving goalposts, it might change. But as of this point, the IRS is saying that it is non-deductible for those expenses, but you will not get taxed on the forgiven loan.
Great. Thanks, Angie. So here was a question that came up. What about bonuses? Can you address if you give a bonus during this period of time and if that's considered forgivable as well?
Yes, it is. So the only caveat there is if you were already making over the $100,000 or if that puts you over the $100,000 salary or income threshold, then you do get limited to that. But even though it didn't allow the bonuses in the calculation when you were originally applying for the loan, it does allow you to calculate those bonuses within that covered period for the forgiveness piece.
Great, thanks, Angie. Jim, at the beginning, you had you'd mentioned one of the key points is that if a business has access to liquidity, that played an important part in your eligibility for PPP. So what if your business does have access to liquidity? Does that kick you out of eligibility for this program, or is that still, are you still eligible?
Angie, do you want to tackle that first?
Sure, and then you can follow up if you kind of want to a bit more on top of that. So it did sound when they first came out with some of the information that it was very concerning that if you did have access to a line of credit, that maybe that meant that you really weren't eligible. And based on the further information that came out, it really is just whether or not you need it based on the economic uncertainty. And just because you have a line of credit or access to other types of lending does not mean you're ineligible for this. I think the majority of small businesses do have access to some sort of line of credit or other loans that they could make, but that doesn't necessarily mean that they're no longer eligible for this. And one of the things in the Q&A that it specifically said is it really is just the current economic uncertainty makes the loan request necessary to support the ongoing operations of the borrower. And so that's kind of the key takeaway from that is, you know, we do feel that a lot of the times you do, even if you have a line of credit, can still really need this PPP loan.
Yeah, I would echo what Angie said, but I would just say that, you know, that April 23rd rule did throw a little bit of scare at many small businesses as it relates to, did they have access to other forms of liquidity? I think it was more geared towards publicly held companies that were in the headlines around that time period. And I think this was SBA and the Treasury's way of trying to say, you know, you guys better turn that money back in because we're going to come down hard on you. I don't think for a small business, due to the economic uncertainties that they faced then and continue to face, that I would lose much sleep over the fact they have an unused line of credit on their books.
Great. Thanks for that clarification. Health savings accounts. You listed a long list of things that were included that could be included in the payroll costs. Are health savings accounts one of those pieces that are included?
Angie, do you want to take that?
Yes, I actually was just looking that up a few before this call, and let me see if I can find the specifics. Do you know, in general, I think in general it's considered okay, but I was trying to determine for sure on that one.
If it was an employer portion of the HSA, so like in our firm, we offer our employees so much to be in the, into the HSA program, that if it's an employer cost, I believe that would be included, the HSA employer cost. Obviously not the employee deferral, but just the employer share that they're paying on behalf of their employees.
So we're going to try to get to as many questions as we possibly can. Some of them are going to be very specific, and some of them I'm trying to lump into more general questions. Here's one as an example that they paid out sick and vacation to their employees. And is this included in the payroll wages for the 8-week period if they also receive payment for a 40-hour week?
So they received full pay, and then on addition to that, they received additional, or they were being paid 40 hours, but part of that was considered their vacation and sick leave, which I'm assuming is probably.
It's looking to me like they paid, they were on a 40-hour week, and then they also received vacation and sick leave as well, paid. It was paid out to them.
I would say yes. If they paid that in the 8-week period, I guess one could argue that you've got the incurred question, which means that if Jim Roy went ahead and decided to take the opportunity to be given, 110 hours of time that I had accrued, and I've elected to have it paid to me because my spouse was a victim of the pandemic, I don't know if I could take all of those hours, since I only earned sick and vacation during that 8-week period, only the sick and vacation in that 8-week period. Angie, would you agree? We couldn't take, a cumulative amount of 100 or 200 hours that were incurred last year because those costs were not incurred during the 8-week period, those payroll costs.
Yeah, I think it's definitely interesting if you have a 40-hour work week and you get paid 40 hours and then take the sick, whether or not it's definitely, I haven't seen any guidance specifically stating you can take that above and beyond. I have seen where if people are taking, sick and PTO and things like that because they're home with kids or things like that, that yes, that does apply. But taking it above and beyond, I haven't seen anything specifically regarding that.
Yeah, I'd agree with that.
Jumping back to this, the taxability, the tax issue related to the forgiveness of these loans here. So this question was that, you know, if these expenses aren't deductible because you've been essentially paid for, right? Those expenses have been essentially been paid for by the federal loan, then in reality, this loan that you're receiving is a taxable loan. Can you clarify and maybe explain how that kind of works, Angie?
So it's not a taxable loan. However, the amount of the deductions would get reduced. So you do have a higher amount of net income in the end that you would end up basically paying taxes on, which is why I know that that's something that there's a lot of discussion as to whether or not they really should be deductible or not, just because they feel that that somewhat hurts the purpose of this program. Is if you or those all of a sudden are non-deductible, then you don't get quite as much benefit out of getting this forgiven loan than if you could still use those expenses towards your net income.
Can you speak?
Yeah, I'd agree. I would agree with Angie on that, and just offer up another just point of view that Congress's intent was to make the debt discharge non-taxable. And I believe that there will be congressional action taken before the end of the year that will most likely settle this question. And you know, the intent of Congress was that this was not to be taxable, which means small businesses should be able to deduct the payroll, should be able to deduct the expenses that are being incurred during this 8-week period. But it's not that way now. IRS has already come out and said we are not going to. We're ruling that these expenses are not deductible, and so it takes Congress now to remedy that.
Thanks, Jim and Angie. We've got a lot of questions. We're going to do our best to get through them. Thanks everyone for participating and staying with us and shooting us questions. What about tips as it relates to your salary calculations? Do you work in tips at all?
Oh, so tips like for waiters and things like
Correct.
that?
Right.
I would assume so, Jim, wouldn't you? I mean, that's considered part of a person's gross pay that they would end up tips.
Yep.
Yeah.
Yep. Tips are included in gross compensation paid.
Great question. On the bonus question, what if you're paying out a bonus during this time period, but it's a bonus based upon performance for the previous year? There's lots of great little twists to this stuff.
You know, if your bonus history reflects that, if you have a history of paying bonuses during this 8-week period that you're in, and it is based on prior year performance, then I believe it does not meet the incurred part of the equation. I have advised clients in this recent 8-week period that they're in to look at performances year-to-date 2020 and where they might be making the bonus disbursement later in the year or early in 2021. I'm advising them to consider taking 8/52 of what would be a 2020-2021 paid bonus back into the covered period. Because I do think it's important that everybody that is doing this understands that the concept is not to have a bunch of prepaid expenses or bunch in a bunch of expenses from a prior period into this 8 weeks. I have no problems recommending to a small business that if Jim Joe Jones is online to receive a 2021 bonus based on 2020 operations, consider paying 8/52 of that in this 8-week period, and recognize that you're getting some financial support by doing that. But I'm always thinking in the moment. I am not recommending to anyone that you should be trying to bunch prior year, prior period, or prepay expenses into this 8-week period. That's a strong opinion that I have. Angie, you may differ, but that's my opinion.
No, Jim, I agree with you. I think that's exactly on point.
Yeah, and I think that answers one of the other questions we had is that, if an employer owner, maxed out their 401k during this time period, if that's not something that they normally do during this time period, they probably shouldn't try to figure that as part of the PPP program.
Yeah, yeah, correct.
What if you have a new business that started in June of last year? Do you still use that ratio based on the 2019 tax return year that is the 8/52, or does that have any sort of a implication for how you figure your ratio for this period?
So if I could clarify the question, if you have a sole proprietor that started his or her Schedule C business in June of 2019, does the amount that is eligible for discharge represent 6 months or 7 months of that individual's Schedule C net income? And is that kind of where you're heading, or do
I
we?
think that,
is there?
No, I
is
think
that
that's
a fair?
right, Jim. I think you're getting it.
Okay. Yeah, I have no basis to answer that any different than to say you must look to your Schedule C net income for 2019 for purposes of getting your amount of payroll costs. Angie, do you know of any different you can take in this regard, or is there a
no?
Or yeah, I don't know of any answer to that.
Okay.
And I think that as they would have had to use that for when they applied for the loan, they probably would have had a fairly small loan amount potentially anyways. It would be my, at least my guess.
The only thing that I'm thinking is if there's some clarification, some clarifying rule that says if you weren't in business for all of 2019, you could annualize if it's your first year in business. So if you earned, $10,000 from June 1 to December 31 of 2019, you could multiply that by 12 and divide by 8, and say, that would be my annualized net income. We will get an answer on that. I think that's a good question, if there is a way you could annualize a short period net income in 2019.
Thanks, Jim and Angie. So you're a sole proprietor and you don't take a regular paycheck for payroll. How does a sole proprietor document their pay when they're not receiving like a regular sort of a paycheck?
Well, and I think
Angie?
there's, I was going to say, I think that you had a really good slide on that, Jim. I was going to go back to, I don't know if you might not be able to move the slides anymore, but there was the one slide that did go through it that I'm trying to find here really quick. That just noted,
yeah.
Go ahead, Jim.
Let me just say that you're going to look to your tax return filed for 2019, because your tax return will show, if you're a sole proprietor, what your Schedule C net income is. And as we demonstrated on that slide that was up earlier, if you're a sole proprietor, your eligible income for debt discharge is based on your 2019 Schedule C net income coming right from your tax return. If you didn't file a 2019 tax return as of yet, you need to do that. because that's what's going to be the documentation. If you're a general partner or an LLC member, you're going to have a K-1 for 2019 that is going to show your self-employment income that you paid self-employment tax on last year. And that becomes the key number when you are looking for your debt discharge in 2020 during this 8-week covered period. So the documentation won't be a W-2. It won't be the fact that you're paid a wage. It's going to be your Schedule C net income if you're a sole proprietor.
I think you hit on there, Jim, is if you haven't already filed your 29 tax return, you need to do that because of the fact that that's what you'll be needing to use. And so that's a really important point. Make sure that people, even though the deadlines for filing have been extended, they need to get their return filed to be able to utilize that.
That nasty chore you've been putting off, you're going to need to finish it up sooner than later.
Yeah, and bank lenders need to have that documentation. If you recall, banks have to have that documentation. They just can't have the number on the form and say that makes sense. And, you know, if I was advising a small business that hasn't done his or her 2019 tax return yet, you know, everybody wants to avoid showing income. It might be to your advantage to show some income.
Yeah.
Just to be perfectly candid.
Yeah.
And
Great.
you don't have to take every expense eligible under the law. You might find it makes more sense to show some income so that you have some net income that you can use for this discharge in 2020. But anyway, we'll get off into some weird tangents that I like to get into, but that's okay.
It's pretty fascinating. So we have a number of folks in the state, as you can imagine, that work from home, particularly as sole proprietors. Are they allowed to deduct things like their home mortgage, water, utilities, those sort of things if their place of business is from their home?
I think, and Jim can clarify a little bit more on the rules when it comes to, you know, how you would segregate that out. But there are a lot of utilities, if you work from home, that you can take within this. But a key caveat on that is if you weren't working from home before and you are now, and if those weren't things that you were taking for a business purpose as of that key date of February, then you can't take them now. And so that's one of the real key items that you need to look at is, you know, if they've been working from home this whole time and these have always been considered business expenses, that's okay. But if there's things that weren't before, say for myself, I've always worked from an office, and then once school's closed, I work from home, that wouldn't count for me. So if I decided to say, hey, I think that, you know, my internet or things like that are business expenses now, that would not apply for the PPP loan.
Got it. Good clarifications there. A lot of this, it sounds like a lot of these sort of questions kind of can be summed up as that if this is your normal course of business, you can, there are ways that you can work it into. But if this is something that's out of the ordinary, whether you're paying yourself or paying your employees or suddenly working from home, those sort of things, if that's not your normal course of business, then it's probably not applicable under the PPP program.
Yeah, I think that it's something that you at least want to make sure that you run by someone else and verify whether or not it is. It doesn't mean you shouldn't be tracking those in case it does come out, if they do come out with some clarifications and say, oh, by the way, we decided, yes, you can include this. You know, it would be imperative, and I think it would be prudent to really track a lot of those that are kind of in that gray area at this point, and assuming that, yeah, you probably will not be able to use them. And so it's ones that you don't want to have in your main calculation, but I still would recommend, if you're not sure and you're waiting for that further clarification, to at least be able to track of them and keep track of them, so you know that if something does come out, that you don't have to go back digging through documents and finding it later.
I'm going to read you a
Yeah.
specific question here,
Yeah.
Angie, and it gets to one of the slides that you had up, and it's clarification on when you receive the money and how you can disperse that money going forward underneath the 8-week rule. So if you received your loan proceeds on the 13th of June, your next payroll that you paid out was on the 15th of June. You're paying payroll on a semi-monthly basis. You include the full 16 or the full 6/15 payroll, and then the next 3 weeks payroll would be paid at 8-week period. Is that correct?
So
I
one thing,
so
oh, go ahead.
yeah. Go ahead, Angie. I'll let you handle that, but go ahead.
I think the key to what you just asked is that they have a semi-monthly payroll, which is more often than the biweekly. So therefore, or less often, excuse me, I said that backwards. But because it's semi-monthly, they can't use the alternative covered period. They have to use the covered period that starts on the day they received the funds. Only if you're getting the biweekly or more often of payroll, biweekly or weekly, are you allowed to use the alternative covered period. I'm not sure if that answered the whole question, but that's at least one of the main things that I think needs to be stressed on that. Is that kind of what you think they're trying to ask?
Yeah, Angie, let me just also say that so if you're on the regular 8-week covered period, in this case, your first payroll is the 15th of June, and you received your money on the 13th. You're now in your 8-week covered period because you're not using the alternative covered period. So on the 15th, your payroll was cut off a number of days before the 15th. It might have been the previous weeks through Saturday. It might have been whatever. But you can only, on that 15th pay period, use the labor that was incurred post 13th of June, or excuse me, on the 13th of June and later. And then when you get to the last pay period in sometime in July, you will be making a payroll after your 8-week covered period that will cover the days that where you incurred it in your 8-week period, but you paid it after the 8-week period. So you still have to be careful that you only get reimbursement on labor incurred during the 8-week period. But the last pay period in that 8-week period will allow you to go out past that 8-week period to the date that you make that payroll to cover those days that were incurred during your 8-week period. So a little confusing, which is why I really like the alternative payroll, because you get to go out to your very first day of your next pay period to start your 8 weeks. But in this case, they're not eligible, and you have to be careful in terms of what you pick up. So hopefully that helps.
I'd like to knock out a couple more questions if you all
Sure.
have time, Angie and Jim.
Yes, definitely.
It'll be done at 11:30. It's 11:33, and I'd like to knock out a couple more questions if we can. What about union dues? Are they considered part of the covered payroll costs? I would assume they would be. The employers.
I'm not aware of any union dues being eligible. Are you, Angie?
No, I haven't seen anything specifically stating for the union dues whether or not they would. They wouldn't be part of payroll, but I'm not sure whether or not they would be considered under utilities, but they're not specifically noted. So to me, that means at this point, the answer would be no, unless they further clarify that.
Except, I just thought of something, except if the union, like if you're in a Teamsters union and you're making a monthly payment for health and welfare, that's health insurance. If you're making a monthly payment for your multi-employer pension plan with the Teamsters, that is. So those would be Okay, but union dues that are associated with health and welfare and associated with retirement would be considered, in my judgment, a payroll cost. However, union dues that are purely dues, or maybe you pay certain apprenticeship dues, those type of dues are not eligible. Does that make sense?
Yeah.
Clear as mud. Is there a specific definition of seasonal employee or of a seasonal employer? I take that back. And then let me lump in with that, because this person asked a couple of questions in that is they were looking at, one, is there a specific definition of a seasonal employer? And if past due rent can be included as part of the PPP. If you're behind on your rent.
So if you're behind on your rent, I think that would be very similar to if you're paying things, you know, outside. It wasn't incurred during that. So I think only the rent you pay that actually was incurred during the time frame. If it was for something that was incurred prior to that 8-week period, I would say, no, that's not something that you need or that you would be allowed. Jim, have you seen a full definition on the seasonal employer?
I have not, but we will include that in some Q&A and get back to everyone on that. That's a good question, but I have no answer on that. I think seasonal employer would be someone that, you know, is open during just certain times of the year, whether it be Christmas season, whether it would be, you know, a fireworks stand that has seasonal sales of fireworks. I mean, I just don't have a definitive definition, but I'm sure there's one out there.
Mm-hmm.
You're self-insured for health insurance purposes. Do you use the health insurance premium that you charge to employees, or do you use the actual medical claims paid?
Good question. In my judgment, you would use the amount of the premium established based on your actuarial calculations. If it's a fairly significant self-insured plan, but you know, if employees have monies withheld from their paycheck to pay their share, those monies don't count. But any amount that the employer deposits into a checking account that will be used for premiums only in a self-insured plan, in my judgment, would qualify as health insurance premiums.
Great. Well, we've extended this a little bit. I didn't quite get to all the questions. We had a lot of questions, and I'm greatly appreciative of the questions we got, the engagement. There's a lot of interest in this subject. Angie and Jim, is there a way that we can, that you would be interested in sharing this slide deck in some manner outside of this recorded version? We can have a conversation offline, but we've got a number of folks that like to have this slide deck, you know, for their own purposes, to kind of go back and look at some of this information.
Yes,
sure.
And I think the other things that we were to offer is, you know, if there is a lot of questions that didn't go unanswered, if you want us to provide those in a Q&A follow-up afterwards to the attendees as well, we're happy to do that.
Great. Well, thanks again for everyone. Thank you to Angie and Jim at AZ, true experts in this field. And I think that's one of the big takeaways that I feel like I took from this is probably one of those instances that you don't want to try to cut corners and try to figure this stuff out yourself. It's important that you look to experts that can help you navigate this, because this issue continues to evolve. I got a note while we were sitting here that the U.S. House just passed legislation addressing PPP. So this continues to be a moving target. Maybe the work that Cary and I did with Senator Daines earlier this week has paid off already. We'll take credit for that if we can, if it's good. So thanks. And I also want to make sure that I thank the Montana Chamber of Commerce's Treasure State members, Northwestern Energy and State Fund and First Interstate Bank. Those folks have been great supporters of the Montana Chamber, and you see them in all the communities across the state of Montana. So thanks to them. Thanks to Cary at the Montana Bankers Association. This has been a great partnership, and I think that this partnership will continue for the foreseeable future as we see that there's a need for bankers and businesses to work together more and more going all the time. And I couldn't ask for a better partner as we navigate these troubled times in our economy here in Montana than having the banks in our local communities and have someone like Cary at the head of the Montana Bankers. And Angie and Jim, thanks again. I mean, you guys were a wealth of information here today, covered a lot of territory, and we're appreciative of your time and your expertise. And it'll take us a couple hours to upload this recorded version, and we'll post it on our website, and Cary will be able to do the same on his website so that you can share this with other colleagues and friends and business owners that weren't able to participate in it and get some of this valuable sort of information. So thanks to everyone again. Thanks, Angie. Thanks, Jim. Thanks, Cary at the Montana Bankers Association. Appreciate everybody's involvement today.
Thank you.
You're welcome.
Have a great day.
Don't forget to hug your banker when they lift social distancing.
That's right.
There you go. I like that.
Thanks, everyone.
Thank you.
Bye-bye.